It's Friday, 24th of May, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, election fever. South Africa's in the coming week could prove momentous for its post-apartheid history and lead to an even more volatile political and economic environment. And the just-announced UK election, what it might and might not mean for the UK's economic future. But first, Neil Shearing joins me once again to look over our shoulders at the week gone by and stare into the distance of the coming few trading days. Hey, Neil.
Hi, David.
I want to get onto all of these elections and the macro and market risk associated with them. But before we do, I wanted to touch on this inflation central bank issue once again. It feels like we can categorize these weeks as hawkish or dovish. And this past week does feel like a hawkish one, doesn't it? We've had those FOMC minutes, we had Eurozone wage data, we've had that Reserve Bank of New Zealand decision, that felt a bit hawky, but also we had UK CPI for April. Yes, we had that big year-on-year drop, as you flagged last week. Apparently that was enough to help Rishi Sunak to call an election. But the details weren't too encouraging, were they? So how much have the past few days clarified when this DM monetary easing cycle is going to get properly into swing?
Well, I think if you take a step back, the message from the data over the past week or so has been that economic growth, both in the US and also Europe, is holding up pretty well. Europe seems to be gaining some momentum. That was the message from the PMI surveys that we've gone over the past week. But also, as you say, that core inflation, underlying inflation, is perhaps easing a bit more slowly than central banks would like. And in the case of the UK, if you look at the 3-month annualized rates of core inflation, actually started to go up again, which is a real concern if you're the Bank of England. So if you put all that together, I think it does mean that central banks will be more cautious when it comes to cutting interest rates. Now, I don't think it necessarily alters the timing of the first rate cuts in the Eurozone. They've committed pretty firmly to a cut in June, but I think it perhaps diminishes the likelihood of another cut in July. I think that's now looking unlikely. In the case of the UK, the CPI data, and then, as you say, that election, perhaps now unlikely that the bank cuts in June. Doesn't want to be seen as being political, so perhaps shift that back to August, the first cuts in the UK coming in August. And then we've argued for a while that we think the Fed will be cutting in September. I think on balance, that's still the most likely outcome. But I think in general, timing of rate cuts push back, expectations of cuts this year perhaps tempered a bit too. Probably doesn't change the end destination, I don't think, in terms of the kind of terminal rate, but I think we're perhaps a bit slower to get there.
So this easing cycle getting underway perhaps a bit later, but still on the horizon. But let's look nearer term. The coming week, we've got another slew of inflation data. We've got US PCE on Friday, lots of inflation numbers coming out of the Eurozone as well. What are we expecting on those fronts? Are any of those numbers, do you think, going to shift the narrative?
I think the Eurozone data could be interesting insofar as what it tells us about the prospects or likelihood for a rate cut in July following the first cut in June. We've penciled in an increase in the core rate of inflation from 2.7 to 2.8% in the Eurozone, and also the rate of services inflation going up from 3.7 to 3.9% year on year. And now there's lots of noise in this data. They should, in theory, adjust for the timing of Easter, but in practice, that's not always perfect. There's some transport subsidies in Germany that are having an impact on the data too. But if services inflation starts to tick up again in annual terms, then that just might make the ECB a bit less likely to cut in successive meetings, having cut in June. So it might just add to the sense in markets that a July cut would be unlikely following a June cut by the ECB. In the US, we get the PCE inflation data. The CPI numbers for April were a bit better, so core CPI rising 0.3% month on month in April. Actually, we think that the core PCE numbers might go up by 0.2% month on month, partly because some of the items that contributed to that 0.3% rise in core CPI, things like motor vehicle insurance, they're measured in a different way in the PCE basket and have a smaller weight. So potentially better news for the Fed, a kind of 0.2% month-on-month increase in the core PCE number would be welcome, I think, by the Fed. I don't think it alters the timing of the first rate cut or anything like that, but will nonetheless be welcome by Fed officials.
Okay, and on to elections this year. was billed as the busiest in history for elections worldwide. As I said, we've just had the UK election announced. South Africa's is in the coming week. We'll be hearing more about that in a bit. We've also got Mexico's on the horizon coming weekend, and the results of India's multi-week vote, of course, week of June 3rd. And then in the back end of the year, obviously, that Trump-Biden rematch in November. I mean, looking at all of these from a global macro perspective, what do you think are the key takeaways for investors from all of this democracy in action?
Clearly, elections matter insofar as we all remember the dates of key elections in different countries, don't we? They're etched into the consciousness of the nation. And clearly, it's also a good thing from the perspective of the health of democracy that so many people are voting this year. Although worth noting too that if you look at the actual number of democracies, several sources suggest that's now starting to edge down. Nonetheless, the fact that so many people are voting is clearly a good thing. However, from the perspective of the economies in question, and indeed the global economy, I think sometimes too much weight and too much importance is attached to the outcome of elections. There are very few examples through history where elections have made a real difference to the macroeconomic outlook, both in the near term and also, frankly, in the longer term. Those elections that have really mattered have been votes where they've altered the political zeitgeist within an economy. So it's not just shifted policy in terms of the incoming administration, but it's also shifted the political orientation of the economy in question too. So you can think about the UK in 1979, that paved the way for 30 years of kind of neoliberal economic policy in the UK. The same is true of the 1980 election in the US. In emerging economies, the 1994 election in Brazil was a really important one, insofar as it cemented the absolutely crucial importance of fiscal rectitude and the importance of getting on top of inflation and tight monetary policy. Those were absolutely critical elections. I don't think when we cast our eye across the world this year, there are many that are going to be that important. And the UK certainly falls into that camp. If you think about the choices in the UK in 2019, it was between a left-wing socialist administration under Jeremy Corbyn or a Conservative administration under Boris Johnson that was pursuing a relatively hard Brexit. Those were two quite big, quite stark choices. This time around, both major parties have tacked to the centre, and I think the implications for the economy will be less extreme as a result. The US, I think, is an interesting one. The US is obviously the big vote coming at the end of the year. That's interesting, not from necessarily the perspective of the domestic economy, although I think you can make the case that measures pursued by Trump will perhaps be a bit more deflationary than those pursued by Biden. But I think it's going to be important for how US-China relations unfold. I don't think it reverses fracturing, the fracturing of the relationship that we've talked about, but I think the form it takes will be critically informed by the outcome of the US election. More focus on tariffs, even more focus on tariffs under Trump and the bilateral trade balance. Under Biden, tariffs play a role, but particularly things like export controls on key technologies and so on and so forth. So the form that fracturing takes, I think, in terms of the global economy, will be critically informed by the outcome of the US election.
Also worth mentioning that Lai Ching-te, William Lai, was inaugurated this past week as Taiwan's new president, talking about important global elections. He was elected in January. And UK and Taiwan elections feed into my next question, which is all about AI. One of the points our UK team makes is that this change of leadership won't have as much influence on the UK's long-term outlook as forces like AI, like the diffusion of artificial intelligence. And of course, we're expecting Taiwan's economy to continue to do very well on the back of this investment frenzy in AI. And it is a frenzy, isn't it? I wanted to talk about NVIDIA's earnings we've had this past week. $26 billion in revenue in the first quarter. For perspective, they were just $7 billion in the same quarter as last year, which I think underlines that frenzy. Growing evidence of the productivity impacts of AI on a sectoral basis. I personally can attest to that because it's going to help me later today edit and publish this podcast far more quickly than conventional tools would have let me do, I guess, just a few years ago. But really, what about AI's impact on a macro level? To borrow from Robert Solow, are we still seeing AI's productivity benefits everywhere but the productivity data? Or are there signs of economic strength at an aggregate level that reflect the fact that these NVIDIA chips that are being bought en masse are being put to work?
Well, I talked earlier at the start of the podcast, didn't I, about how the PMI data for April and May have been a bit stronger, particularly in Europe. I think that has absolutely nothing to do with the AI revolution, I have to say. However, we have seen stronger productivity growth in the US over the past few quarters. Now, as it happens, although we're pretty bullish on the economic impact of AI over the long run, I think it's probably a bit of a stretch to attribute that to AI as well. Although, when you dig into the details, there is some evidence, and our chief US economist Paul Ashworth's written about this, that AI might be playing some role in the pickup in US productivity. So economists tend to decompose productivity growth into two things. One is capital deepening, so the amount of capital that you're giving to workers, but then also what we call multi-factor productivity, which is the efficiency, if you like, with which workers use the capital that you give them. So therefore you get GDP growth output being a function of the number of workers you have, the amount of capital that you give them, and how efficiently they use that capital. Now, if we cast our mind back to the IT revolution in the mid-1990s and early 2000s, the pickup in productivity growth then was partly about capital deepening because firms were investing lots in IT hardware, but also we got a big pickup in multi-factor productivity as well because the internet enabled workers to basically use the capital we were giving them more efficiently and productively. This time around, we've said, well, we think that the AI revolution will also lead to a pickup in multi-factor productivity growth. But when we look at the capital deepening part, that will principally be about investment in software rather than hardware, because large language models, which is the kind of cornerstone of the AI revolutions, principally a software issue. It's not a hardware issue. We don't need to buy more computers. It's all run off of software. And when we decompose the US numbers on productivity growth, there is some evidence that capital deepening is taking place in the area of software. And there's some evidence too that multi-factor productivity growth is picking up. And like I say, Paul's written extensively on this issue. So I don't think it's all of the answer in the US as to why productivity growth has been a bit stronger over the past 6-9 months, but it might be part of the answer. So it might be the case that we're starting to see this seep through. However, I still think on balance, the AI revolution is mainly a macro story for the back end of this decade and the early 2030s rather than something that's going to suddenly transform prospects in 2024, 2025.
Neil Shearing on AI, elections and macro risk and inflation and the DM easing cycle. I'll link to our work on AI and its macro market consequences, including that Paul Ashworth note that Neil mentioned about productivity in the US. AI was the basis of our annual Spotlight project last year. That's an in-depth look at the technology and its economic and market implications. Comprehensive forecasts in there for how AI is going to affect the global economy on a country-by-country basis and much more besides. This year's Spotlight project launches on the 10th of June with a report that looks at whether the US economy and its financial markets will continue to outperform through mid-century. That project will look at the drivers of US outperformance, whether they'll sustain. It looks at whether economies like China's and the Eurozone will ever catch up. It'll come with interactive data dashboards. There'll be in-person and online events and, of course, podcasts and much more besides. So watch out for that project, 10th of June launch. On elections, we've got 2 drop-ins. Those are our short-form online briefings coming up the week of June 3rd. The first, which is on the 3rd, is about Mexico's economic outlook in light of its presidential election. And another session on the results of India's weeks-long election is on the 4th. We'll be explaining what to expect from Narendra Modi's likely 3rd term and India's economic outlook. Details of those on our events page, capitaleconomics.com/events. If you're a subscriber to CE Advance, our premium platform, you get access to all our events, all our data, all our insight, and much more. Find out more about that at capitaleconomics.com/CE-advance. That's /CE-advance. The coming week's a shorter one in the US and UK with a public holiday, but lots of key data beside those US and Eurozone numbers that Neil previewed, including China's official PMI for May and growth numbers for Canada, the US and India. We'll be all over those as they come with instant reactions and more in-depth insight. Again, CE Advance gives you full access to all of this analysis. Now, the morning after Rishi Sunak's election announcement, Neil led one of our drop-ins to discuss the election's macro and market consequences. And here's a clip from that briefing. which I've edited for clarity. In this clip, you'll hear Chief UK Economist Paul Dales and Deputy Chief UK Economist Ruth Gregory, and it starts with Ruth talking about the fiscal constraints that await the election's winner.
I think there are a number of fiscal constraints that will bind the hands of whoever wins the election. Some of these are sort of more self-imposed fiscal constraints. So I think neither party want to repeat the adverse market reaction to the tax-cutting bonanza that led to the abrupt end of Liz Truss's tenure. So it's perhaps not too surprising that both parties are preaching fiscal discipline. And the Labour Party has said that it will stick to similar fiscal rules to the existing ones. But I think there are fiscal constraints that will be imposed on whoever wins the election. So since 2017 and 2019 elections, interest rates have risen relative to economic growth. And that does mean that the higher public debt interest bill, it means that fiscal policy may be tighter, perhaps to the tune of 1% of GDP over the next 5 years compared to the last 10 years. So I think the current prevailing fiscal environment will bind whoever wins the election their hands, and with the Labour Party sticking to similar fiscal rules, it does suggest that the overall stance of fiscal policy will probably be pretty similar whoever wins, I think.
Okay, so the overall stance of fiscal policy remaining fairly similar, principally because any incoming administration is going to be bound by the high levels of debt and needs to keep public debt and needs to keep bond markets on the side. Paul, we've had a question about supply side reforms more generally. Ruth's already articulated that we don't think there's a great deal of fiscal space for an incoming government to spend lots of money in order to kind of stimulate demand and growth. But clearly there's lots that an incoming administration could do on the supply side of the economy to get growth going. What are the key policies that you think are necessary, and do you see any of those happening? And I'll bind that together, or throw that together with another one about house building. What are the prospects for major changes to regulations and policies around house building in the UK?
Yes, I mean, this is the really big question, isn't it? It gets to the nuts and bolts of the UK's long-term economic growth rate. So when you think about supply, I always think about the two components of productivity growth, which relies heavily on investment, and the growth of the labour force, and put those two together and you get the long-term economic growth rate. So in terms of like some of maybe the touchy-feely stuff to start with, two big issues that we know are going to happen over the next 5, 10, 15 years, dealing with climate policies and also securing the most from the potential productivity gains from AI. Our hunch here is that the labour market is going to embrace climate policies more, which I think could be good for investment and productivity if it leads to lots of investment in green technologies. Perhaps, though, the Conservatives would regulate AI with a slightly lighter touch, and that might mean that AI generates a bigger productivity boost in the UK than if it were stifled through regulation, because there was concerns over how AI might influence trade unions in particular sectors, for example, that Labour might be more sensitive to. And then within the investment category, you mentioned home building. Now, the targets that Labour and the Conservatives are talking about are pretty much the same. So it really comes down to two things: the ability to hit those home building targets, and also any changes to regulations that make the system more efficient. Our feeling is that Labour would probably be more motivated to hit its home building targets. It's more open to social housing, and it made a really big deal about home building in new towns in its annual party conference last year. So it seems to be focusing on that. And underneath it, all that would be good for residential investment and the overall economy. When it comes to planning, this is actually somewhere where I don't think we've seen enough yet. So over the next 2 weeks, we're hoping that we'll receive the manifestos from the major parties, and we're hoping for some pretty solid details and policies in there. At the moment, it's a bit unclear what they are going to do, but it is an obvious place to look at. And when we talk to our clients in this sector, planning seems to be blocking home building at the moment, and that seems to be an unnecessary restraint. And then lastly, when it comes to the labour supply issue and the labour force, one thing to talk about is the participation of people in the labour force. And Labour has the Labour Party has some nice ideas and policies to boost participation of females in the labour force. Although you do have to weigh that up against its New Deal regulations on employment contracts, which to some degree could reduce the flexibility of the labour force. So that's a long answer, but essentially it's not clear cut. But I think the key point is that there are differences, subtle differences between the parties. We're hoping to get more information on the concrete differences in the manifestos. But there are things that can be done to improve the supply issue, even if there isn't lots of fiscal money to splash around.
Yeah, completely agree with that. I would add to this point that we talk, don't we? Like it's motherhood and apple pie about the need for higher investment. Nobody can disagree with the need for higher investment. The UK is not alone in this regard, by the way. But no political party has been talking about how they pay for that. In other words, how they raise domestic savings in order to fund the investment that's required. That is something that I think needs to be spelled out. I'm not holding my breath when the manifestos are published, that have to be said, but I think without a credible plan to get savings up, we're going to struggle to get investment up, and that's a critical piece of the jigsaw. Right, Ruth, what does this election mean for the growth outlook for the UK economy? Will a change of government make any meaningful difference to the longer trajectory of the UK economy?
Well, I think, as we've already discussed with Brexit, long decided, and the Labour Party more centrist under Starmer than it was under Corbyn. That there does seem to be less at stake compared to the 2017 and certainly 2019 elections. So I think in terms of the effects on the economy in the near term, inflation will still fall further. We think the economy will probably improve. Our forecast is for GDP to grow by 0.8% this year and 1.5% in both 2025-26. And we still think interest rates will probably be cut in August regardless. And then on the longer term prospects, we've talked a lot about this already, but it seems unlikely that the winner will solve the UK's productivity problem or the economy's low growth problem, particularly given perhaps some of the fiscal constraints that we've already mentioned. Either way, our forecast for economic growth is to accelerate in the 2030s, but that's due to the benefits from AI rather than from any government reforms. And perhaps if that happens sooner, then the winner of the election may be lucky enough to benefit from some of the easing in fiscal constraints as a result, I think.
That was Ruth Gregory and Paul Dales talking to Neil about the consequences of the upcoming election. The full briefing has much more on climate policy, structural reform, and market implications. You can find it on our dedicated election page, which also includes all our key macro and market insight around the vote. As Neil said, one key takeaway from all of this is that the UK election won't be massively consequential in terms of its long-term economic outlook. The same can't be said for South Africa's. It's happening on Wednesday, and if the polls prove right, it'll mark the end of the African National Congress, the ANC's dominance of South Africa's parliamentary system. That's been a feature since the country's first post-apartheid election 30 years ago. South Africa now faces a move to coalition government, and that's a more dangerous world, as Deputy Chief Economist Jason Tuvey and Africa economist David Omojomolo discuss in this conversation. They talk about potential election outcomes for the ANC, including coalition with the Democratic Alliance, or DA, but also what's being called a doomsday scenario, in which the ANC tries to build a majority through alliance with the far-left EFF, the Economic Freedom Fighters. The discussion also takes in what this could mean for the South African Reserve Bank, the SARB, but it begins with David talking about the likely onset of coalition government against the backdrop of the ANC's fading electoral majority.
So the ANC, it's been an electoral juggernaut post-apartheid, and it, at the last election, managed 58% of the vote. This continued the trend of it getting a lower and lower share of the vote at each election since 1994. The mood music going into this election is that trend is going to continue, and the psychologically important threshold of 50%, which represents a majority for the ANC, is going to be breached. And if it is breached, the ANC will thus have to rely on other parties to stay in power. And that's where many of these different permutations kind of come into play. Jason, you published a recent focus. It's a fantastic primer on some of the electoral questions coming up But one of the really, really insightful bits about it is the two overarching scenarios we have in relation to how the ANC could stay in power. So the first scenario would see the ANC's vote share fall just below 50%. And if that happens, this margin that the ANC has to make up to come into power, it will do so by relying on smaller opposition parties. So the IFP and the Patriotic Alliance are kind of prime examples here. And the benefit of this is in such an arrangement, President Ramaphosa would be able to perhaps not have to concede as much in terms of negotiations and could really carry on with his fiscal consolidation and structural reform agenda without as much debate amongst the party and the opposition. The other scenario, which I think is gathering loads of interest, is the ANC support dropping a lot lower than that 50% mark, even closer to 40%. And there's two options, really. The first one is a coalition with more investor-friendly opposition parties like the DA and other members of the multi-party coalition. The DA has been fairly critical of the ANC, but if you look at their policy agenda and compare it to President Ramaphosa's, there's perhaps a lot more similarities than you would expect at first glance. And this potential government of national unity, as it's been termed, could perhaps see more business-friendly policies adopted. And like the smaller party could actually see the president survive and remain in post-election. The other scenario, which is gathering the most attention, is the so-called doomsday scenario of the ANC being forced to align with left-wing parties like the EFF and Jacob Zuma's, or former President Jacob Zuma's MK party. If this was to happen, it's likely because the performance of the ANC in the election is extremely poor. And you'd likely see the president, if he doesn't make some heavy concessions to more left-wing members of his ANC party and the EFF and MK parties themselves, he'd probably have to step down. So following on from that, it's useful to ask Jason how some of these scenarios could affect economic policy itself.
Yeah, I mean, to be honest, you've touched on quite a lot there. I mean, if we think about these scenarios where either the ANC secures a majority, although that seems unlikely, or just gets under that 50% threshold and enters coalition with the smaller parties, then yeah, I mean, by and large, policy continuity will prevail. President Ramaphosa will remain in place and they'll look to push ahead with his agenda. And you touched on some of those things, including fiscal consolidation, addressing the country's creaking infrastructure. One other element I would point out is there's been reports in the past couple of weeks that the government might look to push through with plans to lower the SARB's inflation target. That's been a key issue for Governor Kanyago at the SARB. He's been a proponent of that. And I think, like I say, if there's a coalition with the DA or the multi-party charter, again, largely policy continuity, but if anything, it would push the government in a more investor-friendly direction. So, yeah, they'd certainly need support efforts to tackle infrastructure. That's a key component of the DA's manifesto, certainly. I think it would also actually push for enhanced fiscal tightening measures. So step up in fiscal consolidation, as well as improvements to the business environment. It's also talked about focusing on health and educational outcomes too.
I guess the one kind of aspect that is maybe gathering the most attention is this doomsday coalition of the EFF and the MK party. Could you maybe go into a bit of detail there about what that could mean in practice?
Yeah, I mean, it's fair to say that the EFF's manifesto contains a whole range of policies and statements that are quite radical, very left-wing. It's a near 200-page document, and I mean, at the risk of overgeneralising, there are sort of 5 key areas to focus on, including things like land redistribution, nationalisations, and there's fiscal monetary policy. There's also foreign policy as well, because the EFF is very clear that it would align with China and Russia and against the US in what we are calling factoring global economy. I mean, in coalition, I suspect many of the EFF's most radical policies, such as land expropriation, nationalisations, I don't think they would see the light of day. I think the ANC would certainly push back against those. I think those that are more likely to gain traction are those around fiscal and monetary policy. We would almost certainly see a shift towards a loose fiscal stance, including possibly the introduction of a basic income grant. the ANC, I think over the past few days, has actually said it would look at introducing that, as it has pledged to do in the past. But that would obviously also stoke concerns about rising public debt. Meanwhile, we suspect there would also be efforts to reduce the SARB's focus on inflation. Now, that could come through various steps, either broadening the SARB's mandate, although that would require amendments to the Constitution, which I suspect the next government wouldn't have to require 2/3 majority of seats in Parliament. It could actually revise up the inflation target, or, as the EFF has proposed, undertake regular audits of the SARB to ensure, and this is coming direct words from the manifesto, to ensure compliance with national economic policies and objectives. So yeah, clearly there would be some efforts to take the SARB's focus away from inflation and support broader economic objectives, including to support economic growth. I mean, if we take a step back for a moment though, David, we've been highlighting that regardless of the precise makeup of the next government, South Africa is heading for a more fragmented political system. Do you have any thoughts on how that will affect efforts to tackle things like the public finances and boost economic growth?
I think the simple answer is it's probably going to be harder. I mean, if you take the public finances, they've long been a concern in South Africa. Sovereign debt risks for South Africa are higher compared to comparable emerging market peers. And the government has made quite a few efforts in recent times to try and tackle that. They've turned to austerity quite a bit. They've even saw a bit of a success recently in the primary balance, turning to a surplus earlier this year. But this austerity hasn't been easy, and the ANC has been fighting a battle within itself to continue on this path of fiscal consolidation. Political fragmentation is just going to, essentially turn this battle outwards. There's the obvious left-wing coalition that is gathering attention, and that's obviously going to make any efforts to push for austerity quite a bit difficult, which we touched on earlier. But even the more benign centrist coalitions, if it's, say, with the DA or kind of smaller opposition parties, you've always got that threat of a veto player, where an opposition party can kind of withdraw their support, for coalition support, for kind of any reason, whether they be ideological or political. And if you look at other emerging market peers who are seeing this higher degree of political party fragmentation, it has been associated with larger structural budget deficits, and IMF research even points to kind of worse fiscal dynamics overall. South Africa's local government experience of coalitions provides some clues as to just how fragmentation itself can lead to some suboptimal outcomes on the fiscal perspective. Growth itself is unfortunately a similar kind of story. We've done quite a lot of research recently in regards to South Africa's growth picture. We've touched on how they've underperformed over recent quarters. But if you take a step back, as we always do, in terms of the more structural factors affecting South Africa's economy, there's quite big things that have to be tackled, whether it's educational attainment and what that means for human capital, whether it's other aspects in terms of competitive forces in the economy itself. These type of issues are going to take really tough reform efforts, and tough reform typically tends to be unpopular. And unpopular measures are very easy to veto if you've got a smaller party who doesn't want to be associated with them. So I think the answer is this backdrop of fragmentation is just going to make tackling public finances and boosting growth. I mean, it already was hard, and it's just going to make it harder.
David Omojomolo and Jason Tuvey talking about the coming week's momentous South Africa election. There's a dedicated page all about the election's macro and market risk, which I'll link to in the podcast page. David, Jason, and the team will be reacting to the election results in the coming week. Watch for their instant reactions and in-depth insight. And if you're a CE Advanced client with a specific question about this election or anything to do with macro or markets, you can ask via the Q&A function on the Advanced platform and get a prompt answer from the team. But that's it for this week. We'll be back next week with a special look at our highest conviction macro calls and discussion about what those mean for market outcomes. But until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.